Stocks push higher after a strong close on Tuesday. Metals and IT lead gains while realty and utilities drag.
ITC picks up an initial 39% stake in Yoga Bar owner Sprout Life Foods for 175 crore rupees with plans to hike it to 47.5% by 2025. The move will bolster the company's presence in the health-conscious food segment.
Metal stocks heat up as LME and Shanghai warehouse inventories shrink and analysts turn upbeat on the swift China reopening and stimulus steps.
Stops under the FAME scheme for electric vehicles are set to end on March 31st, 2024, and CNBC-TV18 learns that an extension of the subsidy program may not be on the cards.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Mangalam Malu as well as Sonal Bhutra. Well, it is turning out to be a day where we are brushing off all of the global concerns as we speak. So we have the Nifty, which is up around 0.6%. Yes, the US markets did close lower. We have Brent crude, which has rallied further. In fact, it's up around 7 to 8% in the past 1 month. But that doesn't seem to have fluttered our feathers in today's trading session at least. So we've managed to cross the 20 DMA when it comes to the Nifty. The next port of call would be the 50-day moving average. We have a lot of stocks and a lot of ground to cover in the next 60-odd minutes. A lot of stocks in focus, for example, the metal stocks which are rallying on the back of a brokerage note. Indices, which is coming out with its numbers. Remember, slippages have been at multi-quarter lows as of the last quarter. So what it does this quarter will matter. A lot of M&A activity, which we will be discussing in just the next couple of minutes. Hi, Sonal. Hi, Mangalam.
Hey, Ekta. Hey, Mangalam. Yeah, yes, absolutely. We are seeing the fact that we are decoupling from the global markets, at least for today. There's no impact of what US markets did overnight. And if we look at the Nifty, it is at the day's high as we speak. Nifty IT, it is one of the top gainers, continues its up move. And PSU Banking Index, it was sulking in trade yesterday, and that continues today as well. That's the top loser as far as the sectoral moves are concerned. But Mangalam, as Ekta was mentioning, a lot of M&A action. We've been seeing that in the broader markets as well. So that is something that we'll be discussing.
Yes, we are. In fact, you guys spoke about stocks, and the sector which is doing extremely well right now is the FMCG pack. HUL has moved to the high point of trade. Britannia has moved to the high point of trade. And the other one which is doing extremely well is ITC, up about 1.5%. That's primarily on account of the announcement that they made yesterday. Will pick up an initial 39% stake in Yoga Bar owner Sprout Life Foods for about 175 crores, and they will hike it to 47.5% by 2025, and in the next 3-4 years by the entire company itself. Now, to discuss this, we have with us Suhasini Sampath, who's the CEO at Yoga Bar, joining in to discuss this deal. Thanks a lot, Suhasini, for joining in. First up, congratulations on this deal itself. Just a couple of numbers before we start. You are doing an annual run rate of almost 100 crores in terms of sales. Typically, food companies work in gross margins of anywhere between 30 to 40%. So what are the gross margins that you function at? Secondly, are you profit making on an EBITDA level? And thirdly, what exactly is your online-offline mix?
Thanks, Mangalam, for having me over at this, to speak with you. The first question, of course, our gross margins are higher than what you mentioned because we, deal with products which are higher gross margins, primarily breakfast, and we also, sell bars, which are also pretty high gross margin. From the perspective, we're super excited about this deal. I think, expanding our distribution reach from 6,000 to using ITC's, really strong distribution strength is something that's super exciting for us. Can you repeat the two other questions that you asked me?
One was, whether you are EBITDA profit making, and you said gross margins were higher than the range that I mentioned. What exactly is the range? I mean, if you could give us, is it 40 to 50, 50 plus? And
yeah, it's in the 40 to 50 range. Which is higher than most other, food companies because you obviously trade in sort of, high margin products. We are not EBITDA positive at this point in time, and that's because as we think there is tremendous scale to kind of invest in. We are definitely CM2 profitable, which means that net of marketing, we're obviously profitable. But of course, we're using a lot of that to kind of grow market share. We're a very market share focused company in all the channels where we are present. And we're obviously investing in kind of, building out the team, building out the support system, kind of using new age marketing to, really expand out category share. That's something that we're heavily investing on. But a very healthy kind of, in the startup system, we are known to be extremely careful with the way we spend money.
Okay, congratulations, Suhasini, firstly, on what would be a momentous day for you and, a momentous deal as well for the entire startup community. But I just wanted to ask you about this additional 47.5% stake, which you all will be eventually selling to ITC. What is it contingent on?
I mean, any exit construct is obviously a combination of both your revenue and your EBITDA. And while I can't kind of divulge the exact, valuation, I would say that it is a deal that as founders we feel is completely fair. As ITC feels, has done their best in terms of giving us, a very, very fair construct. And of course, there are plans to build out the company really large, and multiples are based on how large we can actually take it.
Okay. So when you're talking about you are looking at building the company and growing as well, what is it that ITC can bring for you? The scalability that you're looking at, it is 45,000 crore market opportunity, but it's very crowded as well. So apart from cash and expertise, what is the other contribution and growth that you're looking at here?
So obviously, Yoga Bar is uniquely positioned in being like the first health food brand in the country, right? You've had so many occasions where people would go to buy a health bar in a shop and would say, give me a yoga bar, irrespective of the brand that they wanted to buy. I think first movers who use clean ingredients, who kind of focus on health. I mean, Anandita and we have been at it earlier than, at a time when people used to say tasty bikta hai in, India, maybe we were like literally the first ones. And everyone has seen the advantages of being the first mover, like Flipkart, like Oyo, like all of that, right? So obviously there is, the tremendous brand equity of having been the first mover. So while we think that the market is crowded, I think Yoga Bar has carved a very, very early mover advantage space. And from that perspective, the brand is really strong. And because we as entrepreneurs are so passionate about building products exactly like the way we feed our families, I think our consumers have resonated with us. We only produce those products that we feed our own children or our own parents and things like that. And consumers have ended up really, being a champion of this product. Like today, I received more messages congratulating me from all the consumers who've kind of like been part of Yoga Bar's journey. And I think that for us signifies that while we do see competition,
we get that. Suhasini, we get that point that you obviously are first movers, etc. But that's also one of the risks, right? Because companies which are first movers usually get disrupted by people who've gotten in later with less legacy costs and less trial and error. We'll talk about that in just a bit. But with regards to the scalability that ITC can provide, you said you're available in 6,000 stores. ITC is available in more than 4 million stores. Just wanted to understand, what is the scale that we're talking about here? I mean, if we were to look arithmetically, the sales could grow up by almost 50 times, but that's unrealistic. On a realistic basis, what's the scalability for revenue for you guys? And you said X of marketing spends, you are EBITDA positive. What as a proportion of your sales are marketing spends right now? What do you think it will normalize at once it scales?
Sure. I think so. With ITC's kind of support, we are going to get like a very, very large distribution. But along with that, we're also going to get logistics support, supply chain support, sourcing support, etc., to further improve your margins and things like that. But the point being, of course, in FMCG, you can't do the math like that, because as you incrementally increase your stores, the throughput per store, declines as you go beyond the first 50,000 and the next 50,000, etc. But from a perspective of being a 100 crore brand in 5,000 stores, you can sort of like imagine that 5,000 stores is actually a very, very small representative of the number of stores where Yoga Bar can actually sell. So from that perspective, the potential is very, very high. Because and you asked me this question earlier, how much of your sales is online and offline? We have 50% of our sale coming online, right? And in large platforms like the Amazons and Flipkarts of the world, we are the #1 selling breakfast brand. So from that perspective, if we have to repeat some of that success offline, you can well imagine how large this company can actually be.
Okay. So Hasni, just a two-part question. One, this additional 80 odd crores, you're not, divulging what those milestones or those contingencies would be. but is there a chance that it could be revised lower if in case those milestones are not met? One. And two, you're tracking, you did around, correct me if I'm wrong, sales of around 68 odd crores in FY22. What are you tracking in FY23? What are you possibly envisaging or internally targeting in FY24?
Yeah, we are a 100 crore plus brand in the current year, right?
Okay.
From the perspective of the 80 crores, it's not contingent consideration. It's consideration that's committed. I actually think, and I'm hoping that given our growth and given the kind of category share that we'll take across multiple categories, maybe we'd be back on the table, kind of having people wanting to invest even more, kind of grow even faster. Obviously, that's the scenario, and that's the entrepreneur mindset with which we go into anything, right? You always expect things to do much better than even what we put on paper. So we're actually expecting that maybe ITC would want to invest more and grow even quicker and even faster.
So, Suhasini, just last question before we let you go, because you're talking about the growth prospects, how you are very optimistic on the brand and the business as well. What made you sell at this point in time, and what does it speak about the D2C world? Because while you were an early mover, there were no funding issues, so to say, but now it has dried up. So what does it speak about the D2C brand and your brand as a whole?
Yeah, so ours is a mix of both, like, raising capital as well, right? Because ITC is committed to the 150 crore consideration for us to really grow the brand. I think entrepreneurs look at, exits to see the kind of legacy that they can leave behind. I take deep satisfaction, both Anindita and me take deep satisfaction in the fact that now this brand is going to live for another 150, 200 years or how many ever years, right? And we're going to be feeding India really healthy food, and eventually with ITC support, we could take this brand global as well. And some of those aspirations for us is far larger than our own personal goals. It's how big can Yoga Bar be, and with an engine like ITC, we see that anything is possible. It could disrupt healthy food as we know it in India. It could disrupt healthy food as we know it in Southeast Asia. It could disrupt healthy food as we know it everywhere. So we're really excited about that prospect.
Asini, thank you so much for joining in, giving us the details of the deals as much as you could. And we would have liked to speak to you about your plans after Yoga Bar as well, but that for another day. For now, the street likes this deal, and ITC is moved to the high point of trade. Yoga Bar does about 100 crores of sales, 50% coming from offline. 6,000 stores is what they reach at right now. ITC reaches about 4 million stores, so there is a fair amount of scalability, and with marketing synergies coming in, it could add to the bottom line as well. 40 to 50% is the gross margin that Yoga Bar as a product trades at. And finally, it also hammers the point that D2C brands, to achieve the scale that they aspire to do, perhaps may have to sell to large-scale FMCG companies. We will monitor this space as we go along. That was the management of Yoga Bar. Let's step into a short break. On the other side, we talk about markets. We connect with Sri Ram Velayudhan, who is the Vice President at IIFL Securities, to discuss the implications of HDFC's revised shareholding.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, HDFC Group is in focus because there is the updated shareholding pattern that has come up. To discuss what the implications could be, also because of the merger that we have been talking about, we have with us Sriram Velayudhan, who is the Vice President at IIFL Securities, and Nimesha will also be joining us to take this discussion forward. Sriram, good afternoon. Thank you so much for joining us. Well, that's really the first question. You have written a note on the updated shareholding pattern as well. Tell us what the implications could be in terms of flows, and what does it mean for the stocks as well?
Hi, good afternoon. So the very important development, both HDFC Limited and HDFC Bank have reported the shareholding for the December quarter. So this assumes importance because in the run-up to the closure of this event, we will have to monitor the foreign room. So in terms of an MSCI implication, the methodology states that, so first and foremost, on a merged basis, when we consolidate the shareholding of both HDFC Limited and HDFC Bank, the foreign room stands at around 17.25%, which is above the threshold of 15% for inclusion of HDFC Bank in the MSCI India Index with an adjustment factor of 1. So this assumes a lot of importance because if HDFC Bank is retained with is included with an adjustment factor of 1, the stock is likely to see potential inflows of around about 2.5 to 2.8 billion before the closure of this event, because HDFC Limited currently has a weight of roughly 6%, and HDFC Bank will attract a weight of roughly 10.5 to 11% in the MSCI India Standard Index. So for the incremental part, the passive funds will have to act on that incremental part, which HDFC Bank will come out in the MSCI India Index.
Got it. Hi, Sriram. This is Nimesh here. I understood, you're talking about 2.8 to almost $3 billion of inflows in HDFC Bank. Tell me, whether it will be at a one go or it will be on a staggered manner. So, any sense on whether it will be at one go, the entire 2.8 billion has to be put in HDFC Bank post the merger?
Hey, hi, Nimesh. Good afternoon. So this will happen at one go.
Okay.
So as we have seen with the merger events that takes place in MSCI.
Okay.
Indices.
Got it. Sriram, I understood the MSCI angle. I also wanted to understand from you what happens to the domestic shareholding, because post the merger, most of the mutual funds will own more than 10% stake, and no scheme or fund can own more than 10%. So in that case, will the domestic mutual funds will have to sell, or you expect some sort of leeway once the merger is done as far as the domestic holding is concerned in HDFC Bank?
So Nimish, I also checked the domestic holding couple of days back, because your mutual fund data gets released by December end. So on an average, if you evaluate across all the equity schemes, the weight is reasonably equal at this point of time. So I don't see any impact. So it ranges between 7 to 9%. So I don't see any impact coming from that leg.
Got it. Fair enough. So that's the HDFC and HDFC Bank. I guess from an MSCI point of view, Sriram, the next big trigger would be the Feb review and some expectations on what can get added to the MSCI standard index. Any work that you all have done and expectations that the few stocks can get added to the MSCI standard index in the Feb review?
Yes, Nimish. So, based on the assessment that we have done, we are expecting inclusion of Bank of Baroda and CG Power in the standard index in the Feb review.
Any exclusions expected, Sriram?
Yes, on the exclusion, the high potential exclusion would be Biocon and Oro Pharma.
Okay.
So both these stocks are currently below the threshold required for a float market cap. So I'm expecting an exclusion.
Okay. And what could be the potential inflow and outflow in the Feb review, as and when these changes do come into play?
So Bank of Baroda, roughly, it's a very liquid name. We are anticipating in both the names, Bank of Baroda and CG Power, roughly the inflows should be to the tune of $130 to $150 million.
Okay.
And Biocon and Oro Pharma, the outflows range between $80 to $85 million if an exclusion pans out.
Okay, well, both those stocks have been underperformers, Biocon as well as Aurobindo. But Sriram, just a quick question with regards to HDFC AMC, and what is the likelihood of an MSCI inclusion in that stock?
Yes, AMC is there on the radar, but I think it still needs some regulatory developments that are happening, because one of the strategic holders is...
Sriram, we've lost you.
Yeah.
It's a bit of a scratchy line, but go ahead.
Yeah. Is it audible now?
Yes. Go ahead.
Yeah. So it depends on the treatment with the index provider decides with the holding that gets disposed of. If let's say the strategic holder who is about to dispose of his stake, if that gets counted as a part of float, that certainly increases the possibility of stocks inclusion, HDFC AMC's inclusion in the subsequent reviews. But based on my assessment, it's still far off from the cutoff levels.
Oh, got it, Shriram. Got it. So, Shriram, you mean there is still no clarity on HDFC AMC getting added to the MSCI in the near future? That's what you mean by that?
Yes, right.
Got it.
Because first and foremost, we will have to check how the holding gets treated by the index providers.
All right, Shriram.
All right, Shriram. Thank you so much for joining in and giving us all those details on a whole host of things, HDFC Twins being the most important out there. But Nimesh, Kotak, what happens to Kotak out there?
So with Kotak Bank, there are few things that one needs to watch out for. One, the December shareholding is not yet been out, so that's something which a lot of investors will track for. That happened in the September quarter as well. Everybody was expecting, at a particular threshold, and it came actually after that threshold, so it didn't get added to the FTSE. So for Kotak, there are two events to watch out for. As far as the FTSE is concerned, there is a very high chances that the stock will get added to the FTSE in the March review. Now, the previous notes do suggest that if it's added to the FTSE, the inflows could be between $700 to $800 million. That's a large sum. But most of the analysts on the street do believe that it will not be at one go, which is what I asked Shriram as well, as far as HDFC bank is concerned, whether it will be in a one-shot go or in a staggered manner. For Kotak Bank, as far as the FTSE is concerned, the expectation are that it will be over a period of say 4 quarters. So there won't be a big impact, but there will be definitely an impact on Kotak Mahindra Bank as and when it gets added to the FTSE index in the March review. So that's as far as the FTSE is concerned. As far as the MSCI is concerned, again, the way Shriram explained about HDFC Bank, similarly for Kotak Bank, the foreign headroom has to be about 25%. It is around 22% is last time that we checked. So this December quarter, filing will be important for Kotak Mahindra Bank as well. MSCI could be a touch and go, but FTSE will definitely happen. The inclusion will happen with $700 to $800 million. Most likely, it's going to be a staggered investment or a staggered inflow which will come into Kotak Mahindra Bank as far as FTSE is concerned.
Okay, all right, Nimesh. Thanks very much for joining in and giving us a whole host of stocks to watch out for. Majority from the financial space. But talking about that, Indices Bank should be on your radar because it is coming out with its numbers today, just about flattened out for that particular counter, just about holding its marginal decline coming in there. Remember that the previous quarter, which is Q2, was extremely strong for Indices Bank when it came to net interest margins, slippages. So whether or not they can sustain that kind of growth into this quarter or sustain those kind of parameters into this quarter will be something that the street would watch quite closely. Time for a break now, but Dharmesh Shah of ICICI Direct will be joining in with trading strategies on the other side. Stay tuned. Welcome back. Well, steady day for the market, so no complaints coming in. Let's see how the earnings pan out. And talking about that, we have a very busy day coming up tomorrow, especially from the consumer space. So a lot of consumer trends to focus on. The likes of HUL, Asian Paints, PVR, Havells, which will be reporting numbers. And besides that, L&T Tech, Happiest Minds, Emphasis from the entire IT space. And Canfin Homes, AU Small Finance Bank, Canfin Homes, I'm talking about that simply because it's managing to hold up quite well ahead of its numbers tomorrow. And even Anant Raj, which is in focus, I think that stock is also sitting at a 52-week high. So that stock also gaining with a move of around 0.7%. Good time then to get a technical check. Dharmesh Shah joins in to tell us what he's strategizing midweek. Dharmesh, hi, welcome to the show. Well, what is it in terms of a call both for the Nifty as well as individual stocks?
Good afternoon, Rima. Yeah, definitely, I think so. The market, we believe, I think so, we should be on the positive side. If you look at the Nifty for last few weeks, I think so, the multiple support has been formed at around 17,800. After all this negative news of US recession and all this, we have managed to hold this 17,800. Going forward, we believe, I think so, market to retest the higher level of upper band of the channel, which is 18,300, and should surpass and should challenge the 2021 high, which was at 18,700. So we believe, I think so, market to trade positive. Any dip, I think so, should be looked as a buying opportunity in the range of 17,900 to 18,000. We believe, I think so, the pre-budget rally has just started, and it should be looking for a target of around 18,700 on the Nifty. So bias remains to the positive for the Nifty. Even if you look at the VIX, I think so, which is a good indicator, which starts trading below 15. So I think so overall, if you look at the scenario, sentiment globally as well as domestically, it looks positive for the market, and 17,800 has a strong support with a target of 18,700.
All right. And individual stocks?
Yeah, as far as sectors and stocks are concerned, we remain to be positive for metal space as a whole. If you look at the metal index, it seems to be regaining the momentum after the last few weeks. And if you look at the sentimental also, I think so the steel price seems to be regaining the momentum on the back of China reopening. And also dollar index to supporting trading below 103, which was a crucial support. We believe in the metal space, the NALCO, National Aluminum, remains to be our top pick. As if you look at the stock has been trading in the last 6 months in a very rectangular formation and has witnessed a breakout of last 6 months of consolidation. We believe for NALCO, the stock should be headed towards 94. Also, if you look at the structural point of view, the 14 weeks, 15 weeks of decline has got witnessed in just 3 weeks. So it seems to be, I think, so more of a faster retracement and indicating a strong momentum uptrend in the stock. We believe for stock to head towards 94, keeping a stop loss of 75.
Okay.
This is the one stock. And apart from that, auto industry, I think so the one looks more positive. Auto, we believe the auto index seems to be regaining the momentum on the back of after retesting the previous 5 years of range breakout. Tata Motors is one remain to be a top pick, where Tata Motors, if you look at the stock seems to be finding the support of the last 14 months of the lower band of the channel, which was around 475, 375, 385, and has taken a multiple support near those levels, which also coincides with the 52-week EMA. We believe the stock to head towards 470 in the near term, keeping a stop loss of 375. Tata Motors is the one which seems to be relatively outperforming going forward.
Okay, all right. Thank you so much for joining us. So that's a technical view on the markets as well. With that, we'll slip into a short break for now. And as we do that, here is an important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list. Welcome back. Still tuned into Halftime Report on CNBC-TV18. Well, I'm focusing on the gas sector today because there has been a cap on gas prices from high pressure, high temperature fields, and this is basically from fields which are more difficult, and this is where a cap has come in from the government. These city gas distribution companies, the fertilizer companies, they have contracted volumes, gas volumes from PMT, from APM gas, that is Administrator's Price Mechanism, and one of them is HPHT, which is high temperature, high pressure gas as well. This is where government has come up with a cap for traders. This has been capped at $0.7 per MMBTU. This is for resale to fertilizer and LPG producers, and $0.2 per MMBTU. This is for the other users, the likes of CGD companies or power sector as well. This is done in order to ensure that traders do not make larger profits here, and also that prices are kept at lower levels for customers. Who are the customers here? The city gas distribution companies and fertilizers, as I just said. So this turns out to be positive for these two sectors. Now, this order has also issued the priority in which this gas will be allocated to different sectors, which starts with city gas distribution companies, then fertilizers, then LPG and power. So city gas distribution companies continue to remain in the priority allocation segment as well. That again is a positive. However, Kotak Institutional Equity says that yes, it is a positive, but it is a short-term positive for city gas distribution companies. This can significantly reduce trader participation when it comes to bidding for this particular gas segment as well, because now traders will not be able to enjoy so much profit. So that's why the interest coming in here will be really less, and it will impact the marketing freedom for traders and hence lower interest in this particular field as well. Additionally, they also speak about the Reliance Industries and BP KG Basin auctions that had started started back in December, they had been suspended in the middle. And Kotak says that suspension would have been done to incorporate new rules regarding margins for traders and also allocation priority. Now that this has been finalized, there is a possibility that the suspension that had happened earlier will be reversed and the auctions will be done how they were planned earlier. There's no impact, so to say, on Reliance Industries because it was expected to start. But yes, this is an important update. Though smaller in terms of the overall volumes, it will be a way in which other segments of gas will be looked at as well. So I just thought we should highlight that.
Okay, all right, Sonal. Thanks very much for that. So that's on the entire oil and gas space. Remember, talking about oil and gas, we do have Reliance numbers coming out on Friday as well. Well, we need to take a short break. Before we do that, here's something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investor, that empowers you to make the right decisions with your money. Nothing in life is guaranteed, but many investors fall for the guaranteed returns gimmick. A smart investor always avoids investing in such schemes and is aware that they are illegal and must be reported to the exchange. Any investment in such schemes is not eligible for compensation from the exchange. Hence, it is wise to avoid investing with anyone promising guaranteed returns in the securities market.
Welcome back. It is that time of the year where we get you big voices coming in from Davos, the World Economic Forum. Now, this one comes in from the Deputy MD of the IMF, Geeta Gopinath, saying that India is very much on the world stage and is doing very well as compared to other nations. So, also, let's listen into Brian Moynihan, who's the chairman of Bank of America, and Raghuram Rajan. So, we have an expert, battery of panels coming in from the Davos summit for you. Let's hear all of them out.
India is doing relatively well when you compare it to other economies in the world. In terms of our growth numbers, we have 6.8% for this fiscal and 6.1% for next. But again, looking ahead, I see a lot of businesses, a lot of companies who are looking to India as an investment destination as they try to diversify away from other countries, including China.
Consumers are still spending. It's up year over year, but it's slowed down, which means the Fed is work is getting done. And so our team says an inflation, a recession, mild recession, end of this year. Next year, inflation has tipped over. The Fed will go 25, 25, 25 in the next February, March and May meetings, but not as aggressively. And that they're saying you're seeing the effects of that. So their view is that the Fed now can be a little more balanced in their view.
If it's a weak recession, a mild recession, doesn't matter that much. They can cut rates eventually. They probably will sometime when they see that happen. And things will come back up. The real question is, do you unearth more problems as you do that? Financial sector problem or something like that.
All right, big voices speaking on the possibility of recession at the World Economic Forum in Davos. Take a short break now. Come back. As always, Manisha Gupta joins in with all things commodities. And today with her is the energy expert, Narendra Taneja.
Welcome back, and joining us on the show now is Mr. Narendra Taneja. He's an energy expert and he joins us from Delhi. Mr. Taneja, hi, good to have you. First of all, on the prices itself, and what a run-up in last 2 or 3 sessions is what we've seen, almost $87 per barrel nudging there. What's your sense on the OPEC report that came in yesterday, which is expecting growth in sense of global demand for this year as well, second year running?
Well, I think I've seen that report, and there are several other reports. But my sense is that when it comes to what OPEC wants and what the ground reality is, there is a kind of gap there. And my sense is when it comes to prices, whatever OPEC may want or OPEC Plus may want. But my sense is the prices, the band is going to be roughly between $85 per barrel to $100 per barrel. I really don't see the demand kind of going through the roof as OPEC would certainly like to have, for that matter, even Russia. But given the geopolitical realities, given the global oil market is now, kind of vertically split into two, and, Russia and China's efforts to de-dollarize, oil trade globally, I think it's all going to have an impact. At the same time, China is still not out of COVID, and America is still facing a bit of recession. Many Western countries are going through, shallow recession nevertheless. So I think the overall situation, at least for coming next 5 to 6 months, is the oil is going to be between $85 per barrel and $100 per barrel. Sometime may cross 100, sometime may go dip even below 85. But roughly the average band is going to be in the region of $85 to $100 per barrel. Look, whenever OPEC comes out with such reports, I mean, OPEC, they also kind of like to create hype sometimes. They like to create kind of artificial, shortage and so on and so forth. That's their job. It's a cartel. It's not a think tank. So whenever you see a report from OPEC, take it with a pinch of salt.
All right, we will do that. Also, Mr. Taneja, when you look at the month of December, the Chinese imports have increased by 4%. So some positive data coming in there. But the reason you would see crude prices not running through the roof is because Russia oil is still coming into the markets, and a lot of it, and at a very discounted rate as well. How do you see the Asian demand vis-a-vis the Russian supplies? And especially, what does it mean for India?
Well, you talked about the Chinese imports. Yes, that is true. But at the same time, look at Chinese export of petroleum products. They're importing, refining, and then selling, petrol, diesel, turbine fuel, and all kind of petroleum products. So that's a major reason that you see what the kind of on the graph when it comes to Chinese import. But I think overall, when you look at China and India are buying heavily from Russia. And what does it mean? That means in China, India are like the second and third largest consumer of oil on the planet, after the United States. So if these two countries have started buying oil from Russia, and Russia is trying to build its own market kind of with its own fundamentals, if possible, if they can manage that, which means that at this stage, the entire thing is vertically split. So it's very, very difficult to predict. And don't forget one thing, OPEC in most cases is with Russia, because Russia can assure better prices, OPEC is with them. But at the same time, the fact that India is buying heavily from Russia, and then in turn, some Indian petroleum products are finding their way to the United States. So it's very integrated and it's very complex at the same time. So my sense is, whatever, G7 may want in terms of your price cap and this and that, but I think with Russia doing what Russia is doing, and China and India importing Russian oil, which means that Russia is helping to keep prices under control. I mean, crude prices are under control in the sense not going through the roof, not reacting to kind of geopolitical trigger, coming from Ukraine. And that's a good news for economies even of the West. Are the Western countries unhappy with oil prices not going through the roof? The America unhappy? No, no one is. So it's extremely, as I said, oil is kind of, is geopolitics. And when it comes to oil geopolitics, it's like a master class, because the way it works is actually far more smarter than geopolitics you see in spaces like, security or defense and so on and so forth, because it's driven by demand, it's driven by the hard economic realities, and at the same time, how to find a way so that you can have the sanctions and still you are not impacted the way you thought you would be impacted adversely.
Absolutely.
Okay, Mr. Taneja as well as Manisha, thanks very much for joining in and taking us through that conversation in the commodity space. Huge run-up for Brent in the past 1 month by around 7 to 8%, but it's a wrap on Halftime Report on that note. This is Lunch. Up next, stay tuned.